Hi guys, today is such a wonderful day outside. That's why I decided to film the video here. And today we're gonna talk about Darden restaurants. We're gonna determine the true fair value of the stock together with you, as we did last time. For those of you who don't know me, my name is Alexander. And for the last 20 plus years, I've been working in the world's leading investment banks and hedge funds, extracting value, finding inefficiencies, making money on the markets by determining the true fair value of an asset and buying it if the current market price is below that number. I'm a graduate of the New York University Stern School of Business. I got an MBA there, and also I got 2 more MBAs, one in London School of Economics and Political Science and one in HEC Paris. I like to study because when you get the knowledge, when you get education in different parts of the world, you start to understand how the world functions, where the inefficiencies are, how to make money on those inefficiencies. This is what we're gonna do together with you. We're gonna find them together, we're gonna determine the true fair value, and we're gonna buy a stock if we see that the current market price is lower than that number. Today we're gonna look at Darden restaurants. I'm sure you all know the restaurants of the Darden Group. You know, it was founded by a guy who was just 19 years old, who opened his first restaurant, which was called the Green Frog in Georgia. And 30 years from that, he opened the first Red Lobster. I'm sure all you've been to Red Lobster. Now it's not part of the Darden Group. Now they have Eddie V's, which is the most expensive, I think, restaurant in their group, and also they have Longhorn Steakhouse, they have Olive Garden. I'm sure you saw a lot of their places there. I think in every state now they have a restaurant because the total number is above 1,800 places as of today. You know that the company published financials a few days ago, and we talked to their CFO and CEO. We always do this. Never invest in a company before you speak to the top management. You have to speak to them in order to determine their view on how the business will develop, how it will grow. They will give you much more insight than any analyst, including me. So better talk to them if you want to make a substantial investment into the company. All right, let's look at the financial report. We always start from the top line. What is the top line? It's the revenues, it's the sales, it's what the company sold, the services, the goods that it sells to get the money. This is the most important figure that we should look at the start to better understand whether the business is growing, is it not moving anywhere, is it stable, or is it going down, is it falling? Let's see. These guys are saying that their sales rose 51% year on year in the last quarter. That means the 3 months that have ended, we are comparing them to the same 3 months last year. So it's basically year-on-year growth. It's not quarter-on-quarter. Never mix that, because there's a bunch of seasonality effects that will ruin the whole picture. Look always at the year-on-year comparisons. Even though last year was a pandemic year, you know, the restaurants were closed, people did not go out. But still, let's compare it to 2020, and then let's compare it to 2019. It's like a pre-pandemic year. Most of the companies do this, and these guys did the same. So 51% is the increase in the sales. Let's break down that number. 48%, 47.5% came from the same restaurants, the same restaurant sales. That means the same places that were there last year sold more. That is good. They also opened 34 new places that are contributing to the net sales. That is also good. So the company is growing. This is the most important. We should always look at the dynamics. This company is growing. It's a good start. Now let's look at the expenses. How much money are they burning to fuel the growth? How much does it cost them to grow? The easiest way is to compare the two rates, the two growth numbers. How much the rate at which the sales grow and the rate at which the expenses grow. Let's see. Expenses grew 38% compared to 51% of the sales growth. That's good. That means they're growing faster than their expenses are growing. That is really good. We always like that when we see that in the companies. Now let's look at the bottom line. The bottom line is the profit. We call it the net income, the net earnings. You'll find different names, but it's basically what is left after all the expenses. It's what the shareholders can hope to get if they want to. Either receive the money back or to keep the money in the company to fuel the growth. But we see here that the company is still growing. That means they should be spending some. They should have some capital expenditures in order to grow. Let's see. The bottom line showed an amazing 3-digit growth, $231 million. That's a lot. And it grew 540% compared to last year. Remember, last year was a special year because everything was closed, but still, it's a good growth number. Now, given that the company made a lot of money, let's see what they do with the money. Do they return it to the shareholders? I think they should, because this is a stable restaurant business. This is not high tech. This is not technology. This is not biotech. This is just restaurant, guys. They have to share the profits with the shareholders if they make a lot of money. Let's see what these guys did. Yeah, buybacks. Remember, there's only 2 ways the company can give money back to the shareholders. The first is the dividends. You just pay out to every shareholder on top of the stock. He holds the stock, he gets like $1 for every stock. That's easy. The second one is the buybacks. Is when the company repurchases, buys back the shares. So the number of shares go down. So if the company continues to make the same net income, it will be distributed among a lesser number of shares. And this will make the profits per share, the earnings per share go up. So this is another way of returning the money, is sharing the wealth, returning the money to the shareholders. Let's see what these guys did. They returned 186 via buybacks. That's good. Remember, they made 231. That's the net profit. That's the net income, net earnings. And they returned in this quarter 186 million via buybacks. On top of that, they returned a dividend. They paid $1.1 of dividend, which amounts to $145 million. See, they returned more during this quarter than they made net profit. That's good. That means that the company is generously paying its shareholders, because not all companies return the money to the shareholders. But some of them are just not very efficient, or the business is not performing well. So this is why we split all the companies, all the stocks into different categories, into different tiers. The first tier is the best one. And it is when we have stable cash flows, and when the business model is so transparent and stable and reliable that there is little risk that the company will make less money than it did in the previous quarter, basically. We have under 100 companies in the first tier. This is the elite. These are the best of the best. The second tier company, like Darden, is when the company is growing, they have positive cash flows, they know how to make money, they know how to grow, and they know how to give the money back to the shareholders. We have thousands of companies in the second tier. I'll tell you why, and when we get to the bottom of determining the true fair value, why we do this. This third tier is when the company is losing the sales. It's like showing negative trends, and it cannot pay the dividends, or it is reinvesting everything that it makes back into the business. So it's not paying the shareholders. This is a bad sign. Most of the times it's a bad sign. If the company is in the market for a number of years and it's not growing really fast and not paying back the shareholders, that means something's wrong with it. That's why we place it in the third tier, because there's more risk for us as shareholders to get back our investment. And the fourth tier is when the company is not making a profit. It's an early stage, it's in a new business, it has a business plan, it shows us a model that it will make money eventually, but it hasn't made money yet. So this is the fourth tier. We will not discuss fourth tier companies with you because they are very specific. You have to really dig deep into the business. Mostly it's biotech companies, and it's not interesting for the most part. I don't think you have companies like that under your portfolio, so that's why we're not gonna spend time discussing that. So let's see, one sec, my phone went off, so we gotta put it back on to see the report. All right. They paid out, as I said, 186 via buybacks, 145 million via dividends. Good, they pay both. This is really good because the dividends are sticky. Once you start paying them, you don't want to lower them because the investors don't like it. That's why companies most of them prefer to pay more in buybacks than in dividends. It's a good sign. management expectations. This is the crucial part in determining the future cash flows of the company. Nobody knows better than these guys. We have Gene and Raj here. Gene is the CEO, Raj is the CFO. These guys are hands-on. They're every day they're spending time looking at all the trends. Nobody knows better. Again, this is why we have to listen to them. If like there are three types of managers that we know of for companies. The first ones are realistic, that are giving the true numbers, and they have a track record to prove, to verify that these are the true numbers. The second one, we call them over optimistic. These guys are they like to to pretend they're better than they really are. I'm sure you met people like that in your life. And the third ones, they are just bullshitters. When you talk to them, they don't answer questions. They say something they don't really know. They're usually not really into the business. And these guys are the ones who should get fired by the shareholders. And we are their bosses. We are the shareholders. They work for us. They need to tell us what they think about the business, how the business will grow. So let's look what these guys are saying. They're saying that the top line will grow 8%. Absolutely realistic. It grew much more because of the pandemic year, but they are comparing to the pre-pandemic levels. They're saying 8% is a absolutely realistic rate of growth. I have no questions about that. They will be adding 35 to 40 new restaurants per year. They already did this. They add 34. So this is absolutely realistic too. And they say in order to open those restaurants, they need to spend, it's called capital spending, capital expenses, $400 million per year. That's not a big number given that they made a profit of $231 million in a quarter. And they want to spend 400 per year. So yeah, absolutely realistic. No questions to that. So now the most important part, determining the true fair value. What we do is we factor in the management's expectations into a basic model. All we need to determine is how much money we will make. What are the cents and dollars we will get by investing into this company today at the current market price? That's very easy, because if we see that the expectations are realistic, and they are, if we talk about Darden restaurants, like not most of the companies. Remember, we discussed Nike last time. I think those guys were over optimistic, and I showed you why, but these guys look realistic. So we factor it in. If we see how much money we'll make in the future, we can count what percentage is that of every invested dollar into this company today. It's a second tier company. Remember, we talked about the tiers. So in order to justify our investment in a second tier company, we need to make additional 550 basis points on top of a risk-free rate. Remember, we can always invest with zero risk, taking zero risk at all. We can buy government bonds. The government will pay us. What is the rate right now? 1.48. Let's make 1.50. We don't need to go like exactly into those bits and numbers. 1.5 is the risk-free rate. So we need to make 550 basis more by investing into this risky company. Remember, we're the shareholders. We're in the bottom line. If the wage inflation goes up, if people don't want to go to work, they'll demand like to double or triple their salaries. We'll get less. If another pandemic hits, people will not go into restaurants, and people will not be eager to deliver the food from the restaurants. So clearly there are a lot of risks that we have to keep in mind. That's why we should get compensated for taking on those risks. And for a second tier company, 5.5% or 550 basis points on top of a risk-free rate is a fair number to compensate our risks. So the yield adds up to 7%. So if we make more than 7% by investing into this company as the current price, that makes this company worth investing. Let's see what our model shows. 7.43%. This is the yield that we will get if we buy the stock today, the current market price. This is above 7%, 43 basis points above. Actually, it's 45, because remember, we used 1.5 instead of 1.48. That is not much. So our recommendation is to buy the stock on dips. It's not a strong buy. You don't buy it right now. You have to buy if the price goes down, because the upside is really limited. Only 45 basis points premium on top of the 7%. This is how we look at stocks. This is how you should look at stocks too. If you want to get a recommendation on the true fair value for any stock that is in your portfolio, just send us a direct message. And remember, never buy a stock before you determine the true fair value of the stock. Thank you for watching, guys. I hope you enjoyed it. See you later. Bye.